although I have, I'll just say it again, I say it every time, although I do have like a PowerPoint slide presentation, if there's a question at any point, don't feel like you have to wait until it's over to ask me. Just simply unmute. There's only like 7 of us here, so I don't think things will get too crazy. Just unmute and ask me the question. Like, you don't have to wait until it's over. Of course, if you want to, you can, but you don't have to. Okay, so welcome to the May meeting for the Baltimore Stock Market Meetup Group. And although it's called Baltimore, obviously we got people from Virginia in the house, and it's open to everybody. Because of technology and everything, you can be anywhere. So glad to have everybody here tonight. We meet the first Tuesday of every month, 7 o'clock, same time. We didn't have one last month because I had a bigger show later in April. Actually, it was an in-person one, and so I didn't do the April one. But we're back here now. It is virtual. I want to do more in-person meetings. So sick and tired of Zoom, but it does allow people from all different places to get together. So it's got its advantages, but I really prefer in-person. I tend to focus on current market events. That's why in the beginning, you heard me and Carrie talking about interest rates and the Fed and crypto and whatever's going on in the market and the economy right now. So the topics kind of vary. There's no sequence of events. It's kind of random, but we always focus on current market events. And as I was telling Tara, we welcome everybody. It doesn't matter what level you are. We welcome all investors. Just the biggest thing is have questions, have comments, and don't think your question is a silly one. There's somebody that's on mute that has the same question. Trust me, so just go ahead and ask it. And right now we've got about 350 members in the actual meetup group. So it's growing. It is growing. I'm your host, Coach Mike, founder and CEO of Walk On Consultants. My 2 main objectives are to get people off the sidelines for the beginners who been thinking about it, procrastinating about it too many times, right? I want to get them off the sidelines and get them investing. So that's one of my main goals. The second goal is for people who already invest, like Carrie, who from time to time may have a question like, hey, I don't know, I'm thinking about buying this stock in an EV maker, or I'm thinking about buying a solar company stock, or what about Procter & Gamble stock? So those are my 2 main objectives, to help people who've never done anything before, and the people who've gotten started, but still maybe have a question or two. So those are the people I focus on helping. I always started with my favorite quote from Benjamin Franklin, that investment in knowledge pays the best interest. And that's why you're here tonight, to get some knowledge. And the only way we get knowledge is if it flows and shares. So I'm encouraging everyone again to share your knowledge. So I had a poll, but I don't know how to do that yet. So I was going to ask you informally, how many people have ever heard of sell in May and go away? If you just unmute and tell me. So Tara's 1. I can't see everybody else. I know my man Eamon has heard of it, and maybe Travis. So I'm going to guess about half the group has heard of it. Carrie, yes, no? I'm shocked. Okay. I thought you would have heard of it before. So sell in May and going away is an old adage. I want to say it started in England. Okay, Carrie? Okay. So yeah, it's a really old adage, goes way back about sell in May and go away. And the theory is that you, May 1st, which was Monday, right? You sell your stocks, or April 30th, you sell everything and come back in November right after Halloween. That's the theory, that nothing happens in that it's like a dead period. A lot of Wall Street traders go to the Hamptons, they go on vacation. There's still activity, but it's a lot less activity in those spring, summer months because people are just like in vacation mode mentally. So not a whole lot happens. And of course, there we go. All right. So here's some of the facts, some of the pros and cons. From 1950 to 2013, it definitely has worked. The data is there to prove that theory, that it does work. And if you look at the 3 worst days in history, they all happened in October, right? In the Great Depression, there were 2 days. And then in 1987, more recently, it was the October crash, Black Monday. So usually you're going to get a smaller return in one 6-month period versus the other 6-month period. And the only, however, and I'll copy the links to Investopedia and Sinking Alpha. I'll put those in the chat so you can look them up for the actual data. But since 2013, it has not been as consistent. I'll just throw that out there. So it does work, but since 2013 has not been as consistent as it has been in the past. Questions? Anybody want to jump in with a comment or a question so far? I know sometimes I get on the road, people are like, I don't want to interrupt them, but okay, cool. So here's the data. Looking in the red, you got from May to October, which I said is sort of a dead period, and from November to April, right? Like I said, it's also sometimes people call it the Halloween strategy, right? You invest beginning of November and you sell at the end of April. And you can see the returns are much better in every sort of category there. The returns are better. The only thing I would say is that it does require some discipline on your part to get in and then get out, to get in and then get out. And are you going to be disciplined or remember to get in and then get out? But it looks like the data supports it, except since 2013, for the last 10 years, it has not been working as well. So let's take a look at this. So far, just the first 4 months of the year, the markets are all up. S&P is up 8.6, Dow up 2, NASDAQ up 16. Pretty good return. So in some ways, it makes sense to just, hey, sell now, take my gains and go home, and I'll wait till later. And if you add in, I put in there, I just updated that today. The first 2 days of May, the market's already down 1%. So it looks like the theory is working. Sell in May and go away, just sell. And just don't be in the market for these next 6 months. Given that, on average, right, if you're in the market for a whole year, you're going to average around 9 to 10% a year. So if you've already got 8% in the S&P or 16 in NASDAQ, why not just sell? Take your money and sit on the side and wait till 2024. Okay, why not do that? So I'm just throwing out some pros and some cons. I really ultimately want you guys to make your own decision because you know what's best for your portfolio. But I like to provide data and information, and then you decide what's best for you. So let's say if you want to try it, right? If you want to sell in May and go away, you can wait till Halloween and buy the SPY. That is a ETF that represents the S&P 500, and then sell it on April 30th. Pretty simple strategy. Buy it October 31st, sell it on April 30th, okay? But since October isn't here yet, what if you want to do the strategy now? You could short the spiders, short the SPY, and then close it out on Halloween. And you see that's a much riskier option for beginners. But I just want to throw it out there because maybe you don't want to wait until October to try this strategy. But it's a very simple strategy. Buy the S&P 500 on October 31st, sell it April 30th. All right. If you don't want to do that, here are your choices. You could remain fully invested, okay? Fully invested, because at the bottom it says time in the market beats timing the market, okay? It's really hard to time the market, although we just looked at a whole bunch of data that says you can time the market, but they don't factor in human psychology when you're like, I don't know, I'm up so much, let me just stay in here, right? So your time in the market beats timing the market. And that's why you get conflicting data. But I would say stay fully invested. You know, whatever you're in, just stay fully invested. You might want to rotate some of the sectors that you're in. You may want to not be in consumer discretionary. You may want to be in consumer staples. You may not want to be in energy. You may want to be in the, utilities, right? You can rotate different sectors. But overall, I think it's best to just have a diversified portfolio. I think of all the strategies, diversification is the best strategy to make sure that you are diversified, okay? You guys have heard me preach that time and time again. So here we have the S&P 500. It's broken down into 11 distinct sectors. The biggest sector is IT, your technology companies. Well, those are your Google, Microsoft, you know, Intel, the chip makers, the software makers. Technology is the biggest sector in the S&P 500. As you can see, all the other sectors still play a role. I didn't know that real estate was actually just a really small part of the S&P. It's only 2.6%. But you can diversify and make sure you have something in 1, 2, 3. You don't have to have all 11. You don't have to have, 5, but diversify. Please don't put all your chips in one basket, okay? Make sure you are diversified. So when we look at diversification for the year so far, this is for the first 4 months, not only is technology the biggest component of the S&P, is also the best performer. It's up 22% in just 4 months, okay? Just 4 months. But again, it was the biggest loser last year in 2022, so it makes sense to me. But here are how the sectors has performed so far. So I want to make sure I get some clarification here. This chart shows you how much of the S&P 500 they make up. like what percentage of the S&P 500 they make. This shows you how they performed in the first 4 months. So communication services, that'd be like your cell phone companies, cell phone providers. Consumer staples are things that we have to buy every day: toilet paper, toothpaste, deodorant, things that will not matter if we go into a recession or not. So I always recommend that, hey, you should have something in consumer staples. Those are the things that are going to be there no matter what. And of course, healthcare, we all get sick, right? Healthcare doesn't have a economic thing, right? Of course, if you have more money, you're probably in better shape because you have access to doctors, but it does not prevent you from getting sick. So healthcare will always be around. But right now, the financials are hurting us because we have 4 bank failures this year so far. So financials are hurting us right now.
Mike, it's Tara.
Yes.
Can I ask a quick question?
Yes.
Can you please define consumer discretionary?
Yes. Things we don't have to have, things that you can put off now or later. You don't have to have a new car. I mean, you may think you have to, but you don't have to have a new car. Things that you don't have to go shopping in the mall. So anything that's not food, clothing, and shelter is discretionary. But I think the problem with America right now, honestly, a lot of us don't know how to separate the two. And that's why we end up with spending problems and saving and budgeting, because what we think we have to have is not really necessary. Food, clothing, and shelter. So I mentioned the toothpaste, deodorant, things like that you have to have. Discretionary is a big flat screen TV, a new video game, a new outfit. I mean, you don't have to have those things. So those things really suffer in a recession, because when it's a recession, you're probably not going to go eat out. You probably cook at home more. So those difference between discretionary and consumer staples.
Thank you.
Good question. Thank you for the question. So I'm wrapping it up here. Just want to say some of the headwinds that we will face, that the Fed is raising rates. In fact, they have a meeting tomorrow. Jerome Powell, how many people know that name? Jerome Powell, he is chairman of the Fed. He's going to raise rates 1/4 point tomorrow. And we've been saying it's going to be a recession. It's going to be a recession. Hasn't really hit us yet, but it's coming. The economy is definitely slowing down. So those are things to consider when you're going to buy stocks. What's the economy going to do? If rates go up, that means it's your mortgage rate, or if you have not bought a house yet and you're trying to buy a house, the mortgage is going to be higher. The car loan is going to be higher. The credit card rate is going to be higher. So you will probably spend less because rates are higher. So those are some of the headwinds that are facing us coming up in the next couple of months. And as I always recommend, what you want to do is keep abreast of the stock market. I watch Bloomberg and CNBC faithfully every day, sort of the way most guys watch ESPN. Use technology to set your alerts for your stocks. You can set something that will trigger and send you a message when your stock's up, stock's down, or there's some really, really big news on your stock. Use technology to your advantage. I mentioned quarterly reports, and I won't go into that now, but you can ask me that later. Review your portfolio, and of course, always just book an appointment, okay? Just book an appointment. That's the best way to get help, all right? I always say learning is a journey. It is not a destination. I've been in the market since the 90s, and I'm still learning new stuff all the time. So if you're casual, on the sideline person, part-time, don't think that you're going to get there. There's never a there. You're always going to keep learning, as I'm still learning. Thank you for listening. I'm your host, Coach Mike, and I'm going to open the floor to questions.